Ooh. All right. All right, guys. Good afternoon. Welcome aboard. Just doing this video after the Fed FOMC 75 basis point rate hike. Kind of going to dissect what happened today in regards to the market, kind of some technical levels I'm seeing, and an update on the Microsoft trade that I talked about this morning, where I got it wrong, and how wrong can I be? Because that's pretty easy to say, because I get it wrong sometimes. Absolutely. But you know what? If you don't like being wrong, you're in the wrong business because you're going to be wrong a lot. It's just the nature of the beast. Today, the Dow Jones fell to 522 points. NASDAQ fell about 1.79%. S&P down 1.71%. Let's go over the round the horn of the macro. Let's go and bring up here today on S&P. We'll bring up the hourly to kind of give us a little bit of context on what happened. So initially, once we had the actual reaction to the 75 basis point hike, which was pretty much priced in. You saw this big wick candle, 38.32 all the way to around 39.25. So we'll call that about a 100-point range. Really, once we started getting to the meat of the Q&A session with Powell, and there was one thing in particular that stood out. And what stood out to him, and I'm going to quote what he said actually. He said, and this is the one where I was just kind of taken aback. That's something that I don't think anyone could have predicted, but he went full hawk here. He said, Fed Chair Powell said that the housing market may have to go through a correction. Literally, that to me screams that the Fed does not care about a pending recession, even though we're in one. That's one thing I don't understand. People are saying recession or future recession when technically we are in one. It's a high demand, high labor market recession, but it's still a recession. 2 consecutive quarters of negative GDP. So back to the hourly. So right when he said that, and I was looking at it on the chart as well. That's when we started really cratering lower. Now, what really stood out on what they said, a couple of things that highlighted to me was one, the dot plot path. And a dot plot path is a way to kind of predict and trend future fiscal monetary changes, monetary policy changes with the Fed, meaning where is the Fed funds future rate going to go from here? Just a simple dots is what they use, not exactly lines and line graphs. So with that being said, I think the number that was talked about today from the Fed was really, I got to look back on it here. Uh, the median, I guess that the happy median between all Fed governors was 125 basis points. So we just did 75. Remember, we didn't have a meeting last month in August. So with that being said, we're not going to have one in October. We're going to have one in November and December. So we need to divide that 125 bips by two. So what is expected? Another round of 75 at least in November. Now that was not priced in by the dot plot that we had previous. We had a possibility of a 50 basis point with the 75 we got today. Now the Fed funds rate in terms of the median level is going to be a 75 in November and another 50 in December. So that Fed pivot or at least a slowdown may just happen in December possibly. What changed with Powell, where we got the initial reaction to the upside, at least in a dovish sense, was that Powell said that there's a fairly large group that would like to see 100 bips by year end. Now, that could be one of two ways. That could be another 75 rate hike in November with a 25 in December, or you could do 50-50. That really, I think that's where the traders and the market is kind of pricing it in, saying that we got at least some sliver of maybe, resolving in terms of less tightening. But that all changed once Powell mentioned real estate. And real estate, again, we talked about it before, guys. It's so key in the economy. And in a relative basis, yeah, housing is kind of cooled. But what the Fed and what Powell is saying, based on their meetings and what he's saying indirectly and directly, is saying we still have a lot more to go. And they really want to kill any kind of speculation which leads to inflation. And I think their mindset is based on the assets out there. It's still in a speculative level. It's not at fair value, meaning housing is too hot, labor market is too hot. Again, they're saying the value is out of whack based on inflation. Now, again, value is perceived by everyone else, but again, this is what they see. The issue I have with the Fed is that you have two things that are really standing out. One, do they tighten us into a recession? What Powell said today that stood out as well was that he said, and I quote, where did he say this? I had it here. We have to get inflation behind us. I wish there was a painless way to do it, but there isn't. So you have that one hand that their path of least resistance is a deep and severe recession. Forget the actual soft landing debate. That's not going to happen. They're just going to tighten until something breaks. Fine. But what's going to be broken? Is it the bond market that's going to be breaking first or just the equity market? So, again, the bond market today, that leads me to my next point. So even with all the things that Fed Chair Powell said today in regards to, we're gonna have to get inflation behind us. I wish there was a painless way to do it, like he just said. And then we have the 100 points and the 150 point in the next two sessions. Well, the bond market really isn't reflecting a hawkish Fed. Now, again, the equity markets are a little skittish. I mean, down 522 points. But again, the bond market, bond yields, bonds were bought today even with this a little more of aggressive Fed. Look at that day today on TLT. So again, what did I say earlier this morning? That the bond market is going to lead us. That's going to be pretty much where we go moving forward. If the bond market at least can catch some bids, because future rates may be less than where we think is going to go in terms of the dot plot, then TLT and these bonds become more attractive because then you start talking about yield peak, where, hey, you're not going to get a 4% anytime soon because rates are going to fall or what have you. Demand is going to be too high. You're not going to be able to catch that bond. So that's the one hand. And then the second hand, we talked about you're just going to break something. The next one they're going to do is really, I think, in a weird way, they could be setting the most horrific expectations. And in the sliver of good hope, of goodwill, they'll just flip. And again, it's hard to trust the Fed when they've had double speak in 2018 when we had the last rate increases. Granted, a different time, a different inflationary environment, but the Fed is not as firm or as cemented as people think. They do change their mind, and the scary part is that they're working on a lag. They're working on lagging indicators, and Fed hikes do not ripple through the economic system for months. So if anything, we're just feeling the effects from the rate hikes from May, technically speaking. So again, labor market still strong. NFP was very strong. The Fed is just going to kind of keep tightening until something breaks or until their bluff is called and they say, okay, we're fine now. So it's really tough to kind of see back and forth because when I look at the bond market, they're not believing Fed Chair Powell. And again, I look to the bond market as at least some kind of barometer looking forward. Let me see if I can compare this to S&P. We'll go to SPY and see if we have any kind of deviation here yet. And then you could see how spread out here that we have SPY and TLT. So does TLT catch up? Remember, kind of reversion to the mean. The last time we had a deviation in terms of the correlation of TLT and SPY has really been Tuesday. That's pretty much the last time we had a bond meltdown on Tuesday or sell off on Tuesday. And now we have a bounce. And now look at the meltdown on SPX. So kind of inverse correlation, at least at this point. But again, it's been kind of being neck and neck or without a couple of big peaks, which was about 2 weeks ago. But again, you can still see TLT kind of leading forward. But if TLT does break out, SPY will and should go with it. And for the only reason alone is that tech stocks only do well for the most part in a low interest rate environment because that's how they borrow money. That's at the end of the day. That's where we are. Let's go ahead and see if I can remove this comparison real quick. So again, a lot of stuff regarding the Fed. Let me see if I can get this comparison line out. Okay. All right, let's go ahead and go over this chart, Microsoft. So Microsoft, we did trade it for this week today. It hit 20%. We gave the members, we told them and say, hey, it's 20%. If you want to close it ahead of time before the Fed, totally cool. We held on to ours. Doesn't look the best right this very second. But again, if you did trade it earlier today, maybe you caught it right at the open. Well done. If you held it, well, it's going to be a little bit of a pain right now to hold it. But we are at support at least in the short term and in the long term. Let's bring up Microsoft with an RSI. We're back on the hourly. Again, extremely pretty oversold conditions. Really, the daily is the one that stands out. The last time we were here, again, at an oversold conditions, we at least popped for a couple of bucks, about 5 to 10. And again, the idea on the Microsoft trade was to really catch something on a bounce somewhat with the Fed. I was expecting the Fed for us to go a little higher, and that did not happen today. I'll eat my crow. But again, that was the assumption based on Microsoft. But again, pretty ugly day all around. Definitely my portfolio got hit with Fed Chair Powell. Now, the question is, we did get the close. What happens in futures overnight? What happens tomorrow? We can kind of give ourselves a little bit of an idea based on the last time we had Fed chair meetings, usually about mid-month. July, the last time we had a Fed meeting, that was right around 7/18. We did bounce. We didn't have one in August. So again, in May, right around mid-month here, we bounced very beautifully. So again, I'm not one to say to create the funeral just yet. Let's wait for the body to die and go forward. So tomorrow is another day. Let's answer the question. Do you think they are just going to flip the script after midterms? I could see them letting the second half of the presidential term go terribly. Oh man, it's tough to say, and I really don't like to mix politics with at least the market, but it does matter. And will that be enough to sway? I mean, God, I'm not one to be into conspiracy theories either. But is there political pressure? I'm pretty sure the White House is probably making some phone calls right now, especially with this stock market. Remember, the stock market, guys, is really the scoreboard for a lot of people. How many people own stocks? If you're on this channel, more than likely you do own stocks at least. It doesn't feel good when you see down 522 on the Dow or down 1.71% on the S&P. The one that really hurts, I guess, in terms of the public is really gas prices. Gas prices are a very big barometer for like financial health. Usually, when gas prices are down, things are doing pretty well, or either really really bad because there's no demand. But when you see high gas prices, again, that affects the psyche of consumers. Same thing with the stock market for investors. These are high net worth individuals. Zuckerberg lost how much, Nick? $70 billion in net worth. I don't care how rich you are. That's a lot of money. I don't care if that's just on paper. That doesn't feel good. So, in terms of the midterm, could we get that sway? Boy, does that line up perfectly or not. Again, the seasonality chart still says pain in September. It still says that. Let me see if I have that chart ahead of me here. Let's go ahead and go to the blog. I have it here. I should just save it on my desktop so at least I can look at it with you guys together. But here you go. I have it on Discord. So check this out. Here is the S&P 500 midterm election year seasonality. Again, this is just historical. Does not mean it's for sure is going to happen. But again, only thing I wanted to catch today was really an FOMC rally or bounce off oversold conditions. We did not get that today. So again, we're still right around, let's call it mid-month. We're right around the 21st, near mid-month. Again, maybe a little bounce coming, and then we get a little more down. Will that be 3,600, 3,500? That remains to be seen. But based on seasonality, it seems to be very, very convenient that right around the beginning of October, historically speaking, we rally into the midterm election. So there is some wisdom there in that mentality. But again, I don't want to base just anything on it either. It is just based statistically. Historical stats, that's basically what we're looking at. But I don't want to think to myself like there's some, you know, other kind of entity out there that's, hitting a switch. Stock market go down today and stock market go up tomorrow. I mean, oh, midterms, let's go rally 1,000 points. I mean, wouldn't that be nice? Just come in and trade right before midterm election season and the presidential elections, and you'd make millions. Wouldn't that be nice? Well, that's all I got for you guys today. Again, always nice to be with you. If you like this video and you want more recaps, let me know. Hit the like button. If this has a lot of likes, we'll do the recaps more often, especially with a Fed day. It needed to be explained at least in English and in layman terms. We'll see what tomorrow brings. But again, on the S&P here, we're really just testing a level that we were at the bottom of July. So near July lows, does it hold 3780 on S&P futures? We closed about 10 handles off 3,800. This is a make or break now. Again, do we get the seasonality approach? Do we roll over into October where, pessimism is really, really down, up? And does that provide buying opportunities? Or is the Fed just going to go ahead and tighten the noose around our neck until we start breaking things? That's where we are. Best thing we can go by now is really just technicals moving forward and see if any other good news comes out or bad news if we get a continuation. Have a great rest of your day, guys. We will see you tomorrow for the morning note. Cheers.